Today. Today, I'm going to talk about how to really strategically invest, find and invest in short-term rentals to maximize cash flow, like big cash flow, even if it's smaller properties. How do we make the most of it, get the highest ROI possible, and some things that we can do strategically to build a competitive advantage. And then the second thing I'm going to spend even more time on for people that make money, earn an income in the United States, especially, is how to leverage the short-term rental loophole and massively reduce your taxable income, not just on the passive income from real estate, but also carry it over against your active income at your job or at your business. So a little bit about me. You can find me on Instagram at Elefante6. I'm a founder and co-founder of several businesses. They're noted here. And over the past 6 years, I've built some of the most, some incredible short-term rental properties across the country that I'm really proud of, and currently have a $25 million short-term rental portfolio. So I'm going to start off with a little pop quiz. I think there's a chat. If you guys want to dump this in the chat, let me know what you think is a quick guess. But if you doubled a penny every day for 30 days, how much money would you have? The answer is $5.36 million. So this is an example to show you the power of compound interest, but this is where it gets really interesting. If you doubled a penny a day every day for 30 days, minus 28% tax compounded, how much money would you then have at the end of 30 days? The answer is only $67,461. So this is the number one thing prohibiting most people, even if you make a high income, from building substantial wealth over the course of your life. It's not necessarily what you invest in, it obviously plays a part into it, but it's how much you have to invest in, because so much of it is getting paid toward taxes. So today I'm going to teach you how to grow your penny into 5.3 million instead of just 67,000. So here's just a quick example. If you make $500,000 in the US, I think this example is particularly for the state of California, you're only left with about $199,000. So imagine that you're making $500,000 and only that little sliver of the pie is left for you to keep, right? Taxes are the silent killer of wealth. So current tax rates, if you're making that level of income, 37% of that, the majority of it goes to federal income taxes. As high as 13%, depending on what state you live in, can go to state income. If you own a company, 15% to payroll. And then if you have capital gains, 24%. And then you have estate taxes when you die, 40%. So you're taxed on the money you make, you're taxed on the money you spend, you're taxed on the investments you make, you're taxed on the property you own, and you're taxed when you die. It's just tax, 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 tax. So going back to high income can be a curse. Now, why do I say that? A high income is great. However, a high income usually gets people complacent, comfortable with the higher level of income, and you become numb to the amount you're paying in taxes, and can also prohibit us from investing strategically to break free of the reliance on a job where we trade our time for money. So today I'm going to teach you how to think like a real investor. So I'm going to focus on two things. How do we supercharge cash flow with your short-term rental investments? Maybe it's with current properties we can improve on, but more importantly, new acquisition. And then two, how do we maximize the tax savings and wealth accumulation long-term? So cash flow, hopefully everyone knows what this is, but it's just what's left over each month after paying all the operating expenses and the mortgage. Right? Cash flow equals freedom. Why do I say that? Once you have enough cash flow from your investments, particularly real estate investments, that covers your living expenses or your desired lifestyle, you are financially free. That's what we're all after, right? Financial freedom. So just as an example, for anyone who's newer out there, rental income minus expenses minus mortgage is what you're left over with. So let's walk through a couple key ways that will help you maximize cash flow on your properties. Number one is, first of all, identifying the most sustainable markets with the biggest upside. So if you're searching for the perfect market, anyone ever been there where you're just stuck on where to invest? You're just looking for like that home run place? Guys, it does not exist. You will be looking until you die to find the perfect market. What I personally focus on is tourism and population growth. So where are people migrating to? It doesn't necessarily mean I'm going to invest in the city people are migrating to, although that could be a good market if the city has tourism and growing tourism. But what are the nearby tourist destinations, ideally that are 3 to 5 hour drive from a growing metropolitan area or multiple growing cities, right? Because if people are moving there, where do you think they're going to start taking significant others, families for trips, right? So as a great example, I live in the Southeast in South Carolina. I grew up in North Carolina. Nashville, Chattanooga, Knoxville, Raleigh, Charlotte, Greenville, all these cities have been growing massively, especially since COVID. And so when these people are moving here, if you drop a pin on a map, that's why the North Carolina, the Tennessee mountains, the Georgia mountains have been such a great market. The Carolinas on the coast where the beaches are has also been a great market. But there's lots of great pockets across the country that fit this criteria. Number two is you got to create a buy box. You can do this on your own. This is just a snippet of one that I have created for myself. But the two most important things when you're looking at amenities, and then we'll get into other key characteristics, are what does everyone have? Okay, this is what a lot of you do is what does everyone have? I just need to have at least most of those things and I'll probably do well. Well, you'll probably do pretty well, but for only so long, because once everyone has those things, now you're just in the average again. You're in the middle. So what I like to do is what are some over the top things that most of those properties don't have or nobody has in that market? This is where you can cherry pick ideas from other markets across the country from really great properties and be the first to introduce that in your market. Next things are location. So when you're looking at top performing properties on AirDNA or STRIQ or whatever sites you like to grab your data from, are there certain pockets where these properties are concentrated in? Okay, who are these people targeting clientele-wise? Are they targeting bachelorette, bachelor, families, right? And then what type of design do they have? What's their design direction? We're gonna get more into design and amenities here in a little bit. I already covered the amenities, the non-negotiables, and then 1 to 3 over the top, and then bed, bath combo, how many people they sleep, do they have a big yard, do they have big common space, so on and so forth. You have to study these trends in order to, one, compete with the top performers, but then to outproduce them. Target markets that have high historical demand, but they're flooded with average properties. I think a lot of people get caught up in the general market research where they're looking at markets that have already been researched for the past decade and flooded with really good properties. You can still do very well there, but it's a lot harder to stand out amongst these people because a lot of the top competitors now find themselves in the middle, again, the average. The goal is to create a one-of-one property, meaning you eliminate competition not only now, but in the future, you make it harder for people to enter and compete with you. So how do we do this? Buy properties that have features that are hard or impossible to replicate. Okay, for example, it's impossible to recreate a view unless you buy a property that has potential views, but you take trees down. That's the only one example, right? So that is an intangible. And if all the top properties have views, albeit the property might be more expensive, if you're looking to differentiate and consistently rent out for a long period of time, people will always pay for something like that. Something that I do really well is look for properties that have bigger square footage and bigger lot sizes. Now, bigger lot sizes isn't necessarily going to help you on the tax side of things, which we'll get to in a little bit, but interior or exterior spaces that are extremely hard to find in other properties. And that way you can add amenities that they cannot add. I'll give you an example. I add golf simulators to a lot of my properties. A golf simulator needs at least 10-foot ceilings, ideally, if not higher, to accommodate a swing. And then you need at least 14 feet of width and 16 to 20 feet of depth. It's very hard to find a home that has an existing room with that space. Same thing on the exterior, right? So like a sport court, you need a large area or you're gonna have to level something out. So just think of those things in the back of your mind when you're searching for properties. Is this hard to replicate based on the terrain or lot sizes or typical houses in my market? I also like buying properties that need improvements for multiple reasons, acquisition and value. So I tend to get under market value when I buy properties. And then I also force appreciation. So if I buy under current appraised value, put a bunch of money into force appreciation, that's creating a bigger and bigger spread. That's all margin for me. So cash flow is great, but equity and net worth is how you become rich, okay? So I like homes that have really good bones, but need a remodel. And then there's less buyer competition, especially for the bigger homes, but homes that need remodel in general, most investors, like 90%, just want the turnkey home, either already furnished or just have to put furniture in. So people do not want to put in the work. So you're creating that value and you have less buyer competition for those types of properties. The financial benefits, you get way higher bonus depreciation, okay? Because we'll get into this again in a little bit, but the bonus depreciation on the purchase is only about 20 to 30% bonus into year one, where you get about dollar for dollar on all the improvements and furniture you make. So every dollar you put into the property, you're getting a lot of that back, almost 100% of that back in reduction of taxable income. And then you set yourself up or position yourself to do a cash out refinance. If the value of the property dramatically goes up, you can then go refi and pull money out tax free and then recycle that money into a new property. And then ultimately will yield a higher cash on cash and total return on investment. And lastly is the guest experience, which guests will pay more for better amenities, better design, all of these things. So number two is how do we actually set up a top 1% property and ultimately eliminate competition? So let me walk you through three factors that separate winning investments from expensive mistakes. So hopefully you guys are familiar with this game. It's really fun to play in real life, but I view a short-term rental market like the Monopoly board. So if you want to let me know in the chat, who typically own, like what card does the winners of Monopoly typically own at the end of the game? So Park Place and Boardwalk. Now notice something very important here. They don't normally have just base rent, right? They end up putting 4 houses or a hotel on it, and look how much more you can charge when you build a hotel on that lot instead of just base rent. So my point here is I'd rather have enough money to put a hotel on whatever type of property I have in that market. Even if it's a smaller card on the Monopoly board, I'd rather charge premium rent and dominate that subset of the market. That's how you differentiate. All right. So yeah, just hit on this. All right. So number one is amenities. It is truly the greatest influence you can have on a property's performance is the experience you provide to the guests through the amenities that they do not get to experience normally at home or have never experienced before. Number two is design. The riches are in the niches. And I'm not saying you have to go design every property like a bachelorette, themed house like I have one of my Nashville properties above. The one below is a family estate style property. Okay, but the design is very fitting to what the guest is willing to pay more for. And this culminates ultimately the experience. Is the experience hard to find anywhere else? Will they leave a 5-star review? Will they go market the property for you and brag about it online? I've had properties where I've had influencers ask to stay at my property for free so they can make content on it. And that has helped drive bookings for it. Zero marketing costs for me, right? It's amazing. And so this is how I look at these cards on the Monopoly board. So even Oriental Ave, which is a much less expensive card, if you start, adding a hot tub, a fire pit, a game room, custom mural, professional design, you name it, you start increasing the average daily rate you're able to charge. And if you get a premium large property, this is where you're able to charge thousands of dollars per night. And this doesn't work in theory. This is practice. This is a booking that I've had on one of my properties, and I could show you hundreds of bookings just like this, where we're getting 1, 2, 3, 4, in some cases, $5,000 a night for 3 to 7 nights in a row. So I'm a baseball guy, so I love this analogy. If you build it, they will come. It's from Field of Dreams. But my theory is if you build it right and if you build it unique, they will come. They will find you. They're already looking in the market that you set that property up in. So be the one that stops them on the scroll, stands out, gets them so engaged with the property, they're sending it to all their friends. How can we afford this? We have to stay here. So just a reminder to wrap this up. Who's your target clientele? Why should someone pick your property over others and pay more for it? And again, will they love it so much they'll not only brag about it online, but come back next year? So providing a unique experience is the number one way to make the most profit. These are some of my clients' properties. You can see clearly they stand out, and great photos is a piece of that in the marketing strategy. So how do we save massively on taxes? This is where I'm going to spend most of my time because this is the greatest wealth building tool you guys can have. And short-term rentals is the key to the ordinary, income earner in the United States to get so far ahead, because most massive tax saving strategies are kind of locked up. If you invest with family offices, you have access to these key, tax harvesting strategies, all these things, but short-term rentals fixes that for us. So depreciation is a reduction in the value of an asset with the passage of time due to particular wear and tear. So the IRS allows depreciation write-off for homes used as rental or business property as a way to recover the cost of the property over its useful life. Allowing depreciation helps incentivize real estate investment by reducing the tax burden on these assets. A lower tax burden can lead to what? Increased investment into real estate or other things, which can in turn lead to economic growth and job creation. It doesn't matter what side you are on the political spectrum, every single president in office is focused on economic growth and job creation. So if you purchase a residential property for $300,000, and let's say $60,000 is allocated to the land because you can't depreciate dirt, the depreciable building value is 240 grand. So if you use straight line depreciation, and typical residential properties, 27 and a half years, short-term rentals is actually 39 years, right? Just an example here. The annual depreciation deduction would be about 8,700 bucks. So if that property did 10 grand a year in profit, and then you took off the depreciation, which is a tax write-off, your taxable income on that rental goes down to just $1,200. Hopefully that makes sense. Bonus depreciation, this is where it gets really special. is a tax incentive that allows businesses to deduct a significant portion of cost of eligible assets of the property into the year they are placed into service, meaning that the year they are actually begin to be rented out, rather than depreciating it evenly over its useful life. So why would the government allow this? Same reason, right? If investors, if you and I have more money in our pockets, what are we going to do? We're either going to invest more, which is going to create more jobs, create more income. It's also going to spur economic growth. We may invest more, we may spend more money. They want you to do this. So how do we actually use bonus depreciation? So you do something called a cost segregation study. And a cost segregation study is something you hire out. You don't have to worry about doing this yourself. You pay an engineering firm, usually between $1,000 and $4,000, depending on the scope of the project. And they analyze the building's components and they reclassify each component into a shorter depreciation period for tax purposes. And then you give this to your CPA to help file on your tax return. So here's an example of the results of a cost segregation study I did. And this is without the cost seg. This is a home I bought, short-term rental I bought in 2023. We launched it in April, which is why the first year is prorated at $16,000. But then you can see about $23,000 per year for the next 38 years evenly. So I could take that as a tax write-off. Now, when you do a cost seg, keep in mind, this was when 80% bonus depreciation in 2023. We're back at 100% now. I'll cover that in a second. 380 grand of that was bonused into year one. Do we know what this means? It reduced my taxable income that year by 380 grand, which saved me $150,000 in actual taxes. So who do you think should have that 150 grand more? You or the government? I won't read anybody's answers here. So at 100% bonus, which we are today, that would have been $223,000 in actual tax savings for me. So the big beautiful bill, whether you agree with the bill or not, one part of that bill was 100% bonus depreciation is back indefinitely. That can always change when there's a new administration, but this is really important. But there is bad news and there's good news. Let me cover the bad news first. For normal rental properties, your losses from depreciation only count against your passive income forms, not your W-2, 1099, or business income, or any other form of active income. So the IRS only lets you take passive losses against passive income, unless you're a real estate professional or AKA rep status. Okay, that means you spend over 50% of your time in some type of real estate business or trade and at least 750 hours a year. So if you work a full-time job, it is almost impossible to qualify for rep status. And any losses from depreciation that exceed your rental profits could then be carried over against all your active income, all your active taxable income. Now, the good news is the short-term rental loophole exists. And you do not need to be a real estate professional to qualify to capture the big depreciation and carry it over against your active income. So why is it referred to as a loophole? It's just considered a loophole as part of tax code, but it's really just because you could potentially use it regardless of what you do as your day job, what line of business you're in, what your profession is, how many hours you work at your job, or how much income you make. You have to hit one of these material participation requirements, not all, just one. Okay, 500 total hours spent on your short-term rental business, or 100 hours as long as it's more time than any other individual person, or more time than anyone else combined. The two easiest ones to hit are 100 hours or the 500-hour requirement. And the average length of stay has to be 7 days or less. So even if you launched a property in December of 2025, or let's say December of 2026, as long as you get it rented out and an average length of stay is 7 days or less before the end of the year, that depreciation is counted in tax year 2026. It's when the property was put into service. So if you bought a property at the end of 2025, but put it into service in 2026, meaning you got it rented out, it would apply to tax year 2026. So I'll give you just a couple quick examples. I bought a property using creative finance. I did a subject to deal where we assumed somebody's mortgage. It's just referred to as creative finance. We only had to put down $79,000 on a $1.25 million home. Year one depreciation was 330 grand and it was fully furnished. Now we're going to make some updates to it, but think about that. The year one depreciation, the actual tax savings, which I think was like $130,000, was almost double what my actual down payment was. So I got paid in the form of tax savings to actually acquire this property. Actually, there it is, $141,900. Another property I just launched recently, if you guys follow me on social media, you've probably seen it. It's the one with the big views and the golf course on it. I did a ton of rehab. Now, this is a property I'll show you on later on. This is, again, this is like my 10th or 12th property, not my first. So these are bigger. However, when you do a lot of work on a property, you do a cost seg for both the purchase and the improvements. And year one depreciation on that property was 1.7 million, which saved me $731,000 in actual taxes. And I saved well over $1 million in taxes in 2025 simply because I'm strategically buying short-term rentals. And regardless if you make 100 grand a year, less or more, there's no reason that you should not be able to take advantage of the strategy to dramatically reduce your taxable income or eliminate it entirely. And this is where it gets pretty crazy. So if you buy one property per year for the next 5 years, and let's just assume you are able to save $30,000 in taxes per year, and then you never bought a property again after that. Okay. That's $150,000 in tax savings, but that's not worth $150,000 to you. So if you reinvested that money each year assuming a 10% annual growth rate, and you did that for 5 straight years, 30 grand a year, and then never invested another dollar again, you would have 350 grand by year 10, 905,000 by year 20, 2.3 million year 30, 6 million year 40, and over almost $16 million if you're still alive in year 50. That is how much that money is worth to you. And that is going back to the penny example of turning it into 5.3 million instead of just 67,000. It comes down to taxes and how we reinvest those tax savings. And on top of that, you'll own 5 cash flowing properties that are all appreciating in value and cash flowing. So it's an amazing thing. So I'll walk you guys through, I think I still have time, a couple recent investment breakdowns. Again, some of these are bigger properties, so don't pay attention to the actual numbers or the property size. Pay attention to the ROI numbers and the general gist of what we're doing to these properties, and you could apply it to any level of property. I don't care if it's a 1-bedroom property or a 10-bedroom property. So this is what I'll call the Airbnb BRRRR method. So we bought it, actually partnered with somebody. We bought it all cash for 1.25 million. BRRRR stands for buy, rehab, rent, refinance, repeat. And the goal with the BRRRR method is to invest money, fix a property up, rent it out, and then do a cash out refinance and pull hopefully all your money back out and then recycle the same money into a new deal. So these are my assumptions. The zip code price per square foot average, or maybe it was the median in this particular zip code in this city, was about $400. Okay, the home was big. It was 6,600 square feet. And we bought it at 1.25 million and it had really good bones. So I already knew I got it way under market value. Well under market value, over $1 million under market value. Converted the garage to a theater room, added about 400 square feet. So I knew reasonably that this would appraise for at least 2.8 million post rehab. And comp analysis suggested I could do 400 grand a year as an STR if I added all the right amenities, had the right design, and catered the right experience to my guests. So here's all the money invested. Again, I usually don't buy properties all cash, and this is actually bought with a partner, not just my own. Hint, you can do that as well. $2 million invested into the deal. I'm telling you this to show you the results here in a second. Some before photos, as you can see, probably passed up by a lot of people. Second homes, primary homes, short-term rental investors. It's a lot of work. So after, this is the garage to a theater room. This is a kitchen we tore out in the basement. We had enough room for a golf simulator. Built a game room, added a home gym. We built a custom fire pit. We rehabbed all the bathrooms, which I think is important for higher end properties because people, especially in vacation markets, staying 3 to 7 days at a time, people will pay more for really comfortable and nice bathrooms and kitchen. We added other great amenities like 2 hot tubs and a sauna, another game room, an office, so on and so forth. You get the point. So the results, it appraised as a residential property, not accounting for operating income, for 3.885 million about 8 months later. We did a cash out refinance and pulled $2 million out of the deal. And when we did the refi, we already cash flowed over 50 grand. So we have a $1.885 million equity position in the property, and we pulled out all the initial money invested. The effective ROI is effectively infinite. Bonus depreciation that year was only 60%, so it would be a lot higher today. So that was $437,000 in change into year one, and it's doing about 400 grand a year. So pretty special property. There's another one. This is probably the biggest project I've ever done. I'm just going to show you side by side before and after what we did. Very similar to the last one. Redid a lot of the bathrooms. We took this shed and basically did a new construction for a game room and movie theater, converted a garage to a home gym. And then we built this custom turf par 3 golf course. So again, something that has never been done in this market that I've seen done in another market. We did it here and it's been a huge hit and the results have been astounding. This is a massive property, but the rental income will be over $600,000 per year. We're planning on doing a cash out refi. Before we do that, because we had a really good purchase price on it, again, because it sat and no one wanted to buy it, our cash flow spread is incredible. We're cash flowing about $30,000 to $35,000 a month on average. Depreciation year one, 1.7 million, forced depreciation over $2 million, and the actual tax savings was 730,000. So you can replicate this, whether it's at this scale or a much smaller scale, applying these same tactics. And these are the bookings we consistently get. So I burned through that kind of on purpose. Hopefully we have time for Q&A. If you guys want to scan that QR code, you're welcome to. Totally no pressure. But if you want to grab a free consult with my team, happy to do it and kind of talk about these strategies with you and how you can apply it to your life.
Nice. Awesome. Thank you so much, Michael. Fantastic. Cool. Yeah, so if you've got questions for Michael, please do fire them in the chat. We do already have a few ready, so I'll ping those to you now, Michael. Just starting at the top with a question from Afrina. What happens when you sell the property and don't want to do a 1031 exchange?
Yeah, so the goal, if you're investing, with tax savings in mind, like at the forefront, you don't want to do big bonus depreciation if you have any intent to sell it in the next several years, because there's going to be recapture. Recapture is basically, looking at what your current basis is in the property, and if you go and sell it, they're going to look at what the straight line depreciation was, and you're going to have to pay taxes back at that point. So the goal is to buy these properties, hold them long term, and there's really no way to avoid that unless you do a 1031 exchange. And for those that aren't aware, that's just selling a property and then you basically kick the tax can down the road and buy another property with the funds from the sale. That property I just showed you, the last one, that was actually a property we sold in Florida, the only property we've sold to this point, and we did a 1031 into that property, which was a good move for us.
Nice. Okay, that makes sense. Cool. Okay, just moving on to the next question. So I'm trying to read these as I bring them on stage. But when we turned several of our properties from long-term rentals to short-term, we found out that we had to pay an extra 15% for self-employment tax. So that was a hit maybe we should have known but didn't expect.
I'd probably get a different CPA.
Love it. Okay. Yeah, look into your CPA. Michael does not agree with that at all. Okay. Carly, I think Michael might have answered this as he went, but is it accurate that you must self-manage, meaning you cannot work with a co-host or property manager to take advantage of all the tax benefits?
No, so we actually have a service called B&B Turnkey where we do the we find the property, design it, set it up, manage it for people. But if they are interested in doing the bonus depreciation and counting against their income, they have to hit one of those key requirements. So if them or their spouse is a stay-at-home mom or dad, then if they can at least hit those hours, they can easily hit rep status and you don't have to worry about the short-term rental loophole. Now, otherwise, you're going to have to make sure that you are able to hit either the 100 hours and more time than any other individual or the 500 hours total, even if you aren't managing the property or doing these things. And I'd say probably the easiest way to do that is if you're very involved on the setup of the property, because that can take a lot of hours. Or if you help manage it, at least for the year it's put into service.
Cool. Okay, that makes sense. Ted asks how do you get the real estate professional certification and what is the benefit to do so?
So the benefit to that is that you don't have to worry about the short-term rental loophole requirements or the material participation requirements. It's not really a certification. It's just, you have to prove that, right? Especially in case of an audit. I don't know if anything goes in your tax return that actually checks the box to qualify or not. I may be wrong. I'm not sure. I'm not a CPA. But really, it's just over 50% of your working time. And you could be a wholesaler. You could be a real estate agent, probably a broker for like a loan officer, I think might be able to apply as well, or a full-time investor. But it has to be at least 750 hours and over 50% of your working time.
Okay, makes sense. Cool. Okay, some more kind of general questions now to give you a little bit of a break from the financing. So what type of team do you have operating this, keeping these types of properties in pristine condition? And then what review process, do you have to kind of help manage those turnovers?
Yeah. My wife and I managed our first like 6 to 8 properties ourselves with no VAs and not like literally no help. And once you get to 4 to 6 properties, you're probably going to either want to build your own team internally. I'd start with a VA or an executive assistant. A VA stands for virtual assistant that can help take some of the monotonous stuff off your plate. Hospitable is an amazing platform because they actually have a lot of AI and automated response stuff built in, VA stuff built in. So that'd be step one, is the most affordable solution to start off. But over time, you may want to have more checks and balances in place. I actually ended up building a property management company with a business partner of mine. And we manage close to 650 properties now nationally. So they help a lot of the day-to-day management for myself. And then outsourcing design, it really helps design and install. So Summerlet Designs, I think they were on earlier today. I have actually a co-owner in that business. My 2 business partners run the business operationally. But at this scale, like I just set up 4 properties at once at the end of 2025. I can't be in 4 places at once. So you really have to have somebody more or less project managing. So that's either you or working with a good general contractor, someone to design, someone to do the install, and then, to help manage the properties ongoing. You kind of figure it out as you go. Like once you're at one property, it's a little bit less important, I would say. But if you want to really hit a point of scale, you're going to need people in place, just like any business, to help operationally.
Nice. Okay. And then we mentioned CPAs obviously a couple of times. Where's a good place to go to find like a good CPA and/or make sure that they know about STRs and the loophole and the requirements?
Yeah, someone has a real estate focus. There's actually a lot of people that talk about short-term rental loophole and real estate specifically that are CPAs. Amanda Hahn with Keystone CPA, someone I personally work with. Her team's amazing. Anna Klein, someone who works closely with me in B&B Investor Academy. And she's big on Instagram. So her and Amanda are both big on Instagram. So you can reach out to either one of those folks. They're great.
Nice. Awesome. Great recommendations there. We've done quite a bit of content with Amanda as well in the past. Okay. Nice question here. If you were to start short-term rental investment today, what would you have done differently?
So differently than when I first started, my first 6 properties did not look like those properties I showed you, right? I've actually went back and redesigned 2 of them since. And when I first started, it was starting to get more competitive. But now it's like design is a must. Unless you have a knack for it, it's not worth the cost savings to do it on your own compared to the ROI you're going to get with that. And same thing with, pinching pennies on, adding great amenities, those types of things. But if you are tighter on budget, this is what I would do differently. Is I've tried to focus on 4+ bedroom properties, especially starting out. And I was stricter on budget at the time. What I would do differently is I would get a 1 or 2 bedroom and try and become the number 1 performing 1 or 2 bedroom in that market. Go back to the monopoly methodology, right? So if I can go build a hotel on a smaller card versus just having enough money to stretch my budget to buy Park Place or Boardwalk, but only charge base rent, that's where you're going to get squashed and regret buying that property and then be like, oh, this property stinks or this market stinks. So that's what I would do differently, is really go all out with trying to become like a one of one type property.
Nice. Okay. Yeah, I like that recommendation. That sounds good. Okay. Jen asked a question around LLCs. If you designated your LLC as a property management company, could you also use the business to help others or owners design and set up, or would you recommend setting up another LLC for that?
Yeah. So you definitely don't want to have your properties in the same LLC as a management company LLC, because the management company is going to be subject to self-employment tax at that 15%. So maybe that's what someone was referring to earlier. So if you want to have a management LLC for management of other properties, I would keep that completely separate from my properties themselves. But personally, my asset protection structure, I pretty much always have each property in its own LLC. Or if you close in your personal name and need to transfer it over, you may want to use a land trust and assign beneficial interest into LLC. And then in the state that the property operates in is where the LLC should be. And there's a more complicated strategies as you scale to have a holding company that holds the properties, or like a tiered structure where you have a limited partnership structure. It's too much to go into right now. I don't have enough time, but Asset protection is really important, right? As you increase your net worth, and how many assets you have, it's important to separate not only business assets from personal assets, but you don't want to get sued at one property and then you have a ton of properties, even if they're business assets, in one LLC, because now everything that's held in there is subject to that lawsuit, and that puts you at great risk. So you don't want to get shut down or have to be forced to sell those types of properties. So.
Cool. Okay, that makes sense. Okay, a question here from Mike. Is there any other way to get past paying the recapture depreciation when you sell the property other than 1031 exchange?
I don't think so. No, I think I touched on this earlier, but the biggest bet is just going to be to do 1031 exchange. But if you have any inkling in your mind that you're going to sell it in the next several years, I'd probably hold off on doing the cost seg, because you don't really want to be in a position to have to pay recapture.
Nice. Okay. And then, yeah, a bit more on the cost seg here. Diane said, CPA told me that all renovations and expenses before a property is placed in service, these expenses are added to cost basis for short-term rental, not deducted on property is placed in service. How are these expenses looked at with a cost seg study?
Yeah, again, I'm not a CPA. I believe there's two ways to deduct those types of expenses, especially like furniture. And I think there's a dollar amount associated with it, like a threshold where it could either be expensed or depreciated. So I would probably just talk to a CPA or cost seg company to get better clarification on. I don't want to give you the wrong info.
That makes sense. And then it was just a clarifying question. I know you mentioned Amanda Han of Keystone CPA as one of the CPAs. Mm-hmm. Who was the other one you mentioned?
Anna Klein, Klein. They're both amazing friends of mine. I've spent a ton of time with both of them. They're sharp.
Perfect. Thank you very much. Okay, I think we have a couple more questions in the chat. Jennifer asked, would you cash out refi if that meant a higher interest rate?
Yeah, so interest rate is one of the factors that I include, but the way I need to look at my investments is return on equity. That's a thing that is not talked about a ton in the real estate world online. So a lot of people look at cash on cash return or ROI the first year, and then they kind of stop thinking about it. Return on equity usually goes down over time because your equity, as you know, real estate in the US has appreciated between 4 and 5% historically year over year. That is going to increase more than your cash flow is going to increase year over year. So your return on equity actually goes down. So what a lot of real estate investors do, whether they force appreciation of property near term and do it, or over the course of 10, 20, or 30 years, will actually go back in and look at the equity that's trapped in the four walls of a property or multiple properties, and how hard is that that equity currently working for me. So that's when someone will consider refining, pulling money out, and is my money working harder now dispersed between two assets, or maybe selling one at 1031 to a better asset, even with the higher interest rate. Again, we need to run what that actually looks like in our analysis, but more times than not, like, who cares what the interest rate is? If I'm able to pull 100% of my money back out and it's still minimum break even, but ideally still cash flowing, all my money's out of the deal and I still have equity in the deal and it's still appreciating. So that's a win-win for me. So I'm less concerned with that, especially now when I have, business income and my real estate, produces a lot in cash flow. I'm a little bit less concerned with conserving cash flow per property as compared to growing my wealth, further reducing my tax burden, so on and so forth.
Cool, that makes sense. Okay, I think we just have two more questions in the chat for you. How expensive is a cost seg?
It's really going to depend on the scope of the project for them. Usually it's property size, and then if there were major improvements to the property. So I would say on a much smaller property, between $1,000 to $3,000. Now there's like the DIY stuff or much cheaper online studies. I would just spend a little bit more and get a really professional company to do it, because the results may not be the same, and you're going to want the company that does it the right way, one, and two, maximizes the tax savings for you. And then a bigger property can anywhere, be $2,000 to $4,000 or maybe even $5,000 for a monster property. But then you're talking also about hundreds of thousands of dollars potentially in actual realized tax savings. It's certainly worth paying for the study.
Yeah, that makes sense. It makes sense that there's so much variability, obviously, based on property and project, everything. Okay, I think the last question for you, Michael, a question from Adam. A little bit unrelated, but how have you dealt with Airbnb's recent changes to the host fee structure while staying competitive?
So the way I look at it is they changed it for everybody, not just me, and it's the same cost to the customer. So at the end of the day, they're looking at price for rentals. They've kind of changed it a little bit over time of what the customer sees. Usually, it used to just be like, what's the average daily rate? Then they click on the listing, then they select the dates, then they show the total accommodation fare, and then there's another breakdown for cleaning fee, taxes, all these things, service fees. Now it's just they actually get a true cost of what it's going to cost them from the get-go. So truthfully, it doesn't really change. And there's different ways, like a Hospitable, you can do markups, right, on different platforms, or markdowns if you want to change the pricing based on platform. But it doesn't really change too much for me necessarily. I might charge a little bit more because it's going to show the same price to the guest. So I actually mark up a little bit.